This is a stock screener. It's called finwiz.com, and it is this screener that I use. Now there are a lot of those on the internet. You might want to find that one that you like better. Its interface or the way it presents the numbers, but I think this is one of the best, and it's finwiz.com. I have no affiliation with it. Now, how do you go about picking stocks? Here you can screen by descriptive, where you can select the exchange, the market cap, earnings, price, index, the dividend yield if you're looking for a specific dividend stock, and so on. The average volume, target price, if you're looking for any specific short interest, and so on. Next, which is more important, is the fundamentals. Fundamentals, usually I don't buy anything which is over 40 PE. But of course you can change that number. If you feel comfortable with buying stocks that are 50, 60 PE, you can change that here. Same thing applies for the price to free cash flow. I don't buy anything over 30. Again, you might change that. It also depends on what industry you are trying to buy in stocks. Of course, if you want to buy tech stocks or you're into software stocks, semiconductors, you might want to raise those values here. Usually banks, insurance companies trade at a lower PE. The other thing that I select usually is the ratio, the long-term debt versus equity. Now this is just an arbitrary number. I put 0.3. But again, I tend to buy companies that have lower debt compared to equity. Again, you might want to change that. Here, going back to the price to free cash flow, anything over 30, 40 price to free cash flow, I believe the stock has been overbought and you're gonna pay a premium for it. It means that the stock price was pushed up by a lot of trading activity, a lot of momentum, a lot of greed of traders, and eventually once you get in at a higher price and you buy it, then you might lose a lot of money. The other thing that I select here is the sales growth over the past 5 years. To me, anything below 15%, if a company doesn't grow their sales over the past 5 years 15%, for me it's not worth buying. The other thing I select here is the return on equity. I just put positive here. You might want to change that number. If you target a return on equity of 5, 10, 15% minimum, you can change that here. The other thing that I want to see is the EPS, which is the earnings per share, growing. This year I set it positive. You might want to select something here for the EPS growth quarter over quarter. I don't usually do that because some of those companies are cyclical. They run in cycles, and it could be that they don't have that EPS quarter over quarter. So I'm not going to put anything here. Now, I believe that this is the most important indicator, which is the return on investment. If a company doesn't return at least 15% on the investment, for me, it's not worth buying it. Period. If anything that returns less than 10%, well, then I'm gonna stick with the broad market ETF. So I'm gonna set here over 15%. You might wanna select a gross margin. I usually don't. The price to sale, I usually don't. EPS growth, the sales growth quarter over quarter, I usually like to set this positive, but again, it doesn't have to be. The other thing which is very important is the net profit. For me, if a company is not clearing at least 15% of the revenue, it's not even worth it to go there. So I'm gonna set that at 15%. So once you set all those values, you're gonna come up with a few companies. Now here you're really screening out of, I would say, thousands and thousands of companies, and I am left with 28 companies. Out of 1,000 and thousands of companies, I am left here with 28. 28 companies that meet these criteria. Now here you might want to screen for a PE ratio, descendant, the price, the daily change, and it'll sort everything out for you, and the daily volume. Like a DocuSign today was a high volume trading stock, Celsius. Now, it doesn't mean that I'm going to buy all of those. Of course, there are other things that I want to look at, but I believe that this is a good primary filter. I want to do a couple of case studies and see what we come up with. Now, usually, if I buy one of those stocks, is for the long term. It is important to know what to buy, when to buy, and when to sell. Those three main things. Now, this is only the first step here, and it's not even complete. Like I say, this is only a primary filter to weed out all of those companies that you're not interested in. Now, let's look at a couple of those. Again, this also depends on the sector that you are more familiar. Now you have here biotechnology, insurance, energy, software, banks. Again, you might want to pick from the field that you are more familiar with. Let's look at this. Medpace Holdings, MEDP. Now here you can see the trend as well. It's been said that the trend is your friend. There is also a way to sort it out with technical. In that case, you can come here and look at the technical, like all your 50-day moving average, 200-day moving average, of course the 52-week high, the 52-week low, and I believe a lot of you guys are interested in the pattern, and here you can see if you are looking for something in particular, like a wedge, a channel up, support, resistance. Now I usually don't get into technicals a lot, because if I buy for the long term, eventually that's gonna take care of itself. Usually if I buy off of fundamentals, but technicals are important too. And again, it depends on your value system. Here again, this one right here, it looks like it might break up. MEDP. What I usually do, I'm going to macro trends, and I study the company a little bit more in details. I look at the income statement. Now those are revenues, and it's a nicely growing revenue. Here you can see how year over year they were able to raise the sales, the gross profit, the net income. It looks pretty good to me. This is a good company. In 2023 they sold about 2 billion, and they cleared over 10% of that. I think it's pretty good. Here usually see the shares outstanding and see if they were diluting the shareholders. Actually, on the contrary, because they've been buying back shares. They went from 38 million shares to 32 million shares, which is a good sign. So far so good. Let's look at the assets and liabilities, total assets, cash on hand, about 40 million, and now they're holding about $500 million in cash. Let's see on the debt. The debt, they pay down all their debts. I think this is a pretty good company. It could be a candidate. Now it's in the medical field. It depends on your preference, if you like the medical field or if you don't, but nonetheless it looks good, at least on paper. The PE ratio is about 32. The price to sale is about 5.5. Price to book 13. Is a bit on the high side, paying 13, but it depends on the industry. I think for the medical, pharma, you're pretty in line with what the industry is. The price to free cash flow 21, about 22. I think it's fair. I think this could be a good candidate to buy. The quick ratio, debt to equity ratio. This company doesn't have any debt. I think it's a good thing. If a company can make 15% profit without having any debt, it's a pretty good sign. Okay, then also to see what Seeking Alpha has to say on that. Again, here you're gonna find a lot of the same thing, but I like to see other websites as well. A medical company in North America, Europe, and Asia, based out of Cincinnati, Ohio. Here, pretty much a lot of the same things. Here, it compares with the S&P 500. Gross profit, EBITDA, net income. It looks good. At least it looks good to me. Market cap about 10 billion, half a billion in cash. 3% of the short interest. It looks good on paper. It looks good on paper. Other thing that I do usually is going to market B. I like it in here because you can see the insider trades. Now here they've been selling. The CEO, this is a US Congress member, but you can get a good idea on who owns the companies and what they are doing. The ownership, about 78% owned by institutions, and they've been buying. They are a net buyer of this company. Here, the market value. Renaissance Technologies. I think this was the fund of James Simons that passed away recently. Peace to his soul, but nonetheless, this is a very good company that actually I think they beat the return year over year of Warren Buffett. But anyways, you see the process. I look at a few things to come up with a good stock to buy. Now, it doesn't mean that I am going to buy it, but I work on a list of stocks that are potential candidate to buy. And when the price hits a threshold that I believe there is a good margin of safety, I might pull the trigger on it. Now, it doesn't mean, again, that I am going to buy it, but it's one of those likely candidates. Let's look at this one. Siga. Going back to macro trends. look at the income statement. This too has a nicely growing revenue. In 2018 they sold about $500 million, but this company in 2023 sold about 140 million and they clear nearly 70 million. It's about 50% of net income. It looks pretty good. Assets and liabilities, they got about 100 million in the bank, and they pay down all their debts. They have zero in debt. And they're making about 70 million a year. It looks pretty good. They diluted it here a little bit, the shareholders. I don't know why, possibly an acquisition. It looks pretty good to me. Let's see the key financial ratios. Like I was saying, what really matters is the return on investment, and this is you're looking at about 40% in 2023 return on investment. Return on assets, it looks pretty good too, 26, 17, 32, 37%. Return on equity, 34%, 19, 39, 43 over the past 3-4 years. This too looks pretty good. About 80% of gross margin. Going back to Seeking Alpha, Siga Technologies. About 8% of the float shorted. This is a company that it's located in New York. It looks like a formulation antiviral drug for the treatment of human smallpox disease caused by variola virus. It's a small company, 45 employees. Not too sold on that because it's a small cap, but it looks good. I like it. It doesn't really have a lot of debt. It's got 100 million in the bank, and they clear about 70 million every year. I don't know. I'm not too sold on this, to be honest. I'm gonna have to do a little bit more research. Can do another couple of examples here. Let's see, this one, Paycom software. I believe that this is a company similar to ADP. I'm not quite sure on that. It's trading at about 160. Paycom. Usually companies like this I like because I don't think they have a lot of overhead. They sell a service to companies. It's like enterprise software for HR departments. the rise. It's at a huge drop here in 2023, about October 2023. But let's see the financials. The revenue is growing nicely. I like to see this trend of revenue. Looks pretty good. I can imagine that everything looks the same. The gross profit, the net income, real nice. The company is selling 1.7 billion and clears 340 million. It looks pretty good. It looks real good. Let's look at the revenue, the EPS, the growing EPS on the trailing 12 month. Shares outstanding about flat, which is good. Let's see assets and liabilities. It's a company that makes about 300 million every year. Cash on hands, they got about 350 million on hands. In debt, look at the long-term debt. I think they pay it down. They had the 29 million in debt and they pay it off. Pretty good. This looks a good company. I want to see at the operating expenses. The operating expenses about $1 billion last year and going up. But I like that this is a pretty predictable company. You can see from the trend, the net income looks good. Now again, it doesn't mean that I am going to buy it. I might want to do a little bit of research over the past month. That can be a good opportunity to buy. It looks like there was a dip, another dip, and it looks like now it's back to that dip. Again, do your own due diligence. Don't buy a stock because I'm doing so. I'm not even buying it. It's down about 21% over the past 6 months. But I think this actually could be a candidate if the market was to soften up a bit. S&P 500 close to all-time high. It might drop a little bit, and it could be a good opportunity to buy this. Looks good though. I like it. I like it. Small and mid-sized companies in the United States, talent acquisitions, tax credit, scheduling, payrolls. Based out of Oklahoma, which is good. The revenue, the EPS, PE ratio, price to book, gross profit margin about 90%, EBITDA about 33%, net income 27% nearly. Looks really good. The return on equity 33%. Looks good to me. They have no debt. 350 million in the bank. Looks good. Let's go back and see if the cash flow. The cash flow statement, they're paying a dividend. They started paying dividends in 2023. Stock-based compensation, the net cash flow. Oh yeah, they pay a dividend. Let's look on Seeking Alpha, the dividends. The dividends here, it's got about 19% payout ratio, which is good. About 1% dividend. It's not very much. If you're looking for a dividend stock, that's not for you. I mean, you can make more dividend buying the S&P 500 that pays a 1.5. But I think this could be another potential stock to buy. Today is down 2.125, nearly. Dividend history. Yeah, they started paying the dividend in 2023, so they pay it quarterly. 2, 3. They're paying 38 cents. Yeah, it's not a high dividend stock, but it could be a good appreciation stock. Paycom. I don't know. I might actually buy a little tranche of this. I think I like it. Give me just 1 second. I'm here on my E-Trade buying it. But again, I'm only gonna buy a little. I might start a position on that. I'm not sure. I might see. I might sell it right away or hold it. I'm just gonna buy so that I have it right here. I don't know if you can see, but about $5,000 of it. I want to start a position so that I have it and I have it documented. Going back to it, I also want to look at the insider trade of that. They've been selling. Buying in 2023 in November. Well, anyways, there are a lot of reasons why an insider might want to sell. I don't think this is a big deal. They might need to pay debts or do something with the money, but definitely they have been selling quite a bit. Only one insider was buying in the last 12 months. But anyways, we'll see what happens with this. The ownership, see who owns this time. About 88% owned by institutions. They've been buying up until the second quarter of 2024. They were buying, but they have been buying here, buying. So they're net buyers of this stock. Let's see who owns it. Market value. Dimensional, Bank of Montreal, HCBC, Truist, that used to be BB&T. I think they merged with the other bank in Florida. Renaissance Technologies again. I don't know. I wanted to do that. Start a little position in this. Not big deal. If it was to drop, I'm gonna buy a little bit more. If it was to go up, I might sell it right away. I don't know. Let's see the short interest on this. About 7.5 of shares shorted. This was up to September 15th. Competitors. Those are a lot of cloud-based companies. Snowflake, Zscaler. Those are not really competitors. I mean, it might be competitors for the stock, but I was looking for the, let's see, the peers. Adecco, Dayforce. I don't know, Robert Half. Those could be companies too. The one can study. Here actually looks like the Paycom is a bit underperforming over the past year, but it could be a good opportunity to buy the dip. You really never know. Let's see, over the past 6 months. Day. Okay, I think I'm pretty good here. I like the company. I think this company has a good potential. I think you can get it to the right price with that type of fundamentals. I think you might be doing good for yourself. It all depends. No one has the crystal ball. I think I might do another one and then I might wrap it up, but you get the point. First, you'll have to work on a list of viable companies, and then when the opportunity presents itself, you might pull the trigger on it, and then you might set a profit target, like you might want to buy it and set a target. No, I don't know if you are wanting to make 10% on investment, 20%. It all depends. Usually, I want to shoot for at least 20%, one way or the other. If you buy it right, 20%, you should be able to make 10, 15, 20%. Usually I buy and I place a trade order valid for 60 days with a 15% target profit. Again, it depends on you. If you need the money, you might need to sell it sooner. Depends on the market condition. I usually buy good companies. I don't set stop losses. I think they're bad because what happens if you set a stop loss at 7% and the stock drops to 8% and then it skyrockets. I don't think you're just gonna lose a lot of money with stop losses. I like to focus on good fundamentals company and buy at the right price, and at least I would aim to a 15% profit and then sell it. Anything less, look, it's not worth it. If the stock is going up, you might wanna leave it alone and let it go up. If a stock has been going up, there is a good chance that it keeps going up, at least for another week or two. On the opposite, if a stock is at a 52-week low and it has been there, 52 weeks, it's been going down. Now 52 is only an arbitrary number. A stock that has been going down 52 weeks, it might go down 53, 54, 55, 56 weeks in a row. So I think that's actually a good content for short selling stocks. Think about it. 52 is only an arbitrary number. A stock that has been going down 52 times, it might easily go down 53, 54, 55 weeks. Okay, more than not, that's absolutely the case. A stock at a 52-week high, it might run another week or two. Okay, but a stock that has been going down for many weeks, it might keep going down. Like it's been said on Wall Street, never trying to catch a falling knife, and that's exactly the case. Now going back to it, this is a good company that I look at. It's an insurance company. I don't know if you guys are big with insurance companies, but definitely a good steady growth on that company. Let's look at it right quick. Kinsale Capital. Looks like it's hit a little bit of a ceiling here, a little bit of a resistance. But if you buy for the long term, it's worth it to look at the fundamentals. This is your cash flow, net income, nicely going up. The company that pays a dividend, a growing dividend. I like, so far so good. Let's see the income statement. Nicely growing revenue. Really nice revenue. The net income that they made 300 million in 2023 on a revenue of about 1.2. Nice. I like what I'm saying. Let's go look at the assets and liabilities. Cash on hand, about 170 million. Debt, $185 million in debt. But for an insurance company, I think that's pretty normal. Let's look at the price ratios. Insurance companies usually don't trade at a high PA ratio, but it's a bit too expensive for me. Yeah, it's a bit too expensive for me. I wouldn't go any. If you don't mind overpaying for a company, it could be good. It's got a good uptrend here over the past year, or rather 2 years. I don't know. I'm a bit on the fence on this. I think I like the revenue. I like the net income, but I might leave it there in my watch list for now. This one company, let's see, farm products. I think they make eggs. We're gonna look into it. It's about $88 a share. Call income statement. It's a growing revenue. 2023 they made a lot of money. 2023 they made about 750 million in income. This is good. This is they cleared about 15% last year of the revenue. Cash on hand about 800 million in hand. Long-term debt, they pay down all their debt. Well, it's a pretty good company. They got 800 million in the bank, and they're gonna be making possibly another $250,000 this year. I like it. I like it a lot. Let's go look at Siga Alpha. Cal-Maine Foods. I don't think it comes with nearly 5% dividend, 33% payout ratio, which is sustainable. It looks pretty good. It's up 87% this year. Those are also good companies that one can look at. Companies similar to Cal-Maine Foods. You know that we always are gonna need food. That's a good thing. Production, grinding, packaging, marketing, eggs and eggs products. I think they supply to all the Walmarts. Those are good brands. I don't know. It looks like a good company. I do know that they have Walmart and all those, Target and all those. So they have private label to compete with those brands. But company looks pretty good. I like it. They have no debt. They got nearly 800 million in the bank. It doesn't mean that the stock cannot go down. Actually, it's had a pretty run up recently. So I don't know. You might be overpaying here. It's up at 26% nearly in a month. I don't know. I like the company. I don't know. If you buy here, you might then regret it. But nonetheless, it's a good company. Well, I feel like I'm gonna wrap up. This is a process that I use to pick stocks. So far, I've had good luck with it. Let me know what you think. If you wanna reach out, feel free to reach out. Like I say, if you live outside of the States and you wanna invest in the New York Stock Exchange, feel free to drop me a line. If you want to know more, if you live in the States and don't quite meet the requirements to have a margin account, feel free to connect. All right. Happy trading, everyone.